Phil Palumbo is with us for the Bigger Picture, founder, CEO, Chief Investment Officer, Palumbo Wealth Management. Great to see you and Happy New Year, Phil. I haven't seen you yet in 2026. So what's interesting is tech back? Well, you know, for a while, we weren't really looking to tech, and there was a lot of concern about, you know, a lot of circular funding and is AI real and all this. Now?
We never look at things like, is something back, whether it's tech back or the markets are broadening out. At the end of the day, when you look at these businesses, such as NVIDIA and Microsoft, Google, and Amazon as an example, you know, we're in the second, third inning of this, the biggest technological revolution that we've ever seen. So that means there is more wind at the back of these technology companies. And the way stocks work is they take breathers, then they move up and take breathers, or any kind of stock, right? As long as the earnings continue to accelerate. Earnings accelerate when GDP or the economy is strong. And that's the current environment we're in right now.
Understood. You know, what sectors do you like the best? You know, you talk about, okay, so there is potential, obviously, for tech. That has driven us for the last few years. What are your favorite sectors that are going to be your go-to when you comprise a portfolio?
Yes, we never look at any type of sector. We really look at businesses that we feel that have a dominant position in an industry, lots of free cash flow, and can compound that over long periods of time. That's the main objective that we have. Now, what works for us in doing this for about 26 years is that we look for sectors that have been beaten up. For example, last year, software is one of those examples. And we want to understand first, why is that? And the reason why software has been beaten up is because the overhang of AI taking over some of these businesses or less software seats. And so a lot of these stocks, like, for example, Salesforce is one of them that has come down from the high about 30%. And we really want to understand, like, what's going on, and should we be investing in one of those businesses that dominate? And Salesforce is an example that does dominate the CRM business. Their market share is 30%, incredible cash flow, incredible anticipated cash flow over the next 2 or 3 years. Nothing's broken about their business. And that's true for many software companies. So for us, Nicole, that's how we look at what sector's been beaten up, who dominates in that sector, and if we invest and be patient over the next 3 to 5 years, you know, that's how we can make some good money.
Understood. So you're looking for leaders, companies with a moat, with good cash flow, at home and abroad. You think there's opportunities in emerging growth? Like, what kind of, is that here at home that you're talking about that?
Yeah, so emerging growth is a strategy that I started 3 years ago. The idea behind that is to invest in 2 sectors that have dominated relative to the S&P 500 over a 20-year period, and that's technology and that's biotech. So those 2 sectors, we combined it in one strategy we call the emerging growth strategy. So I have 2 portfolio managers that partner with my firm to execute this strategy. The idea behind it is to look, Nicole, where people are not looking, right? So everybody's invested in NVIDIA or Microsoft and Amazon. And of course, we own that in my core strategy that I run. But in the emerging growth, you know, those are businesses that are really growing by 100%, 200%. But yet there's a lot of volatility there. But we feel, you know, they could potentially be, you know, the next trillion-dollar companies the next 5 and 10 years. And so that's a portfolio of about 50 companies. And they're investments that most people are not looking, and that's a strategy that really has outperformed the Nasdaq and the S&P since inception.
I see. Software. Let's talk about that. I mean, you talked about technology, biotech. Is software in that group or not necessarily?
No, software would be separate.
Okay. Tell me more about what you like in software.
So far, like I said, Salesforce is a company that we've owned it for a while, but then we started to add more of it at the end of last year. We're looking to add a little bit more this year. It's been a rough start, though, for all software companies for the same overhang issue that I just continue to talk about. So again, you know, we look at Salesforce as they continue to dominate in the CRM space. They've done a great job with Agentforce, which is their agentic AI. That business now is up year over year, 330%. When you combine the database business, the data cloud business, that's up 114%, both those businesses combined. And now both those businesses combined are a $1.4 billion business within the world of Salesforce. Now, that's not 50% of their revenue. It's 3% of their revenue, and I totally get that. But the growth of that can grow parabolically over the next 2 or 3 years, and then eventually be a significant part of Salesforce's overall profitability, because most of the AI that companies are including in their business models, the margins are much greater than the other parts of their business.
And you're definitely seeing opportunity in Amazon. In fact, you've been increasing your exposure, right? And Amazon's such a multiple faceted company, right?
Correct. Yeah. Last time, Nicole, I was with you, I spoke about Amazon, and I continue to speak about it today. Amazon last year had a tough time. It was only up 6% with the S&P up, 3 times that or greater than that. And for Amazon, Amazon is a company that got hit a little bit last year due to the tariffs for obvious reasons, a big part of their business. But Amazon really has done an incredible job laying the foundation for the e-commerce business, the fixed foundation to their margins to expand in that particular business. Number one. Number two, the cloud business, they hit that 20% number that investors were looking for year over year in terms of growth. Their backlog is extremely strong. Their advertising business now is growing 20 to 25%, high margins. I think Amazon is doing a great job executing overall within their businesses. And I think tariffs fall by the wayside, and you could see some good performance out of Amazon, which you're already seeing year to date.
Understood. All right. Well, Phil Palumbo, it's great to see you. Do you have a year-end target? I know you're sort of doing more stock picking and being very specific, but I mean, do you think at the end of the year we're going to be higher than where we are now on the S&P 500?
I believe the short answer is yes, but there's going to be, I think, volatility this year. Usually you get volatility around the new Fed chair, and you also during the second year of a presidential election cycle with the midterms coming, and there's a lot of volatility around geopolitics right now. So I wouldn't be surprised to see a drawdown of 10 to 20% this year. Ultimately, I do believe we end up higher than we are today. With a specific number, we don't believe in that. It's really difficult to forecast that. For us, again, it's that long-term focus, finding good quality businesses that dominate, high free cash flow, and stick with the long-term discipline. And over time, you'll do really well.
But I can get your optimism through that. Phil, it's great to see you. Phil Palumbo, Palumbo Wealth Management. Thanks so much.